Right, welcome Toby Ricketts, who's the CEO of Margetts, who are responsible for producing the bulk of our investment portfolios at the firm. Obviously, it's been an interesting time in markets recently. When isn't it? Toby's going to talk us through the current outlook with a presentation, and then we'll be answering a few questions at the end. So it's over to Toby. Off you go.
Thanks, Alex. So before I get into the slideshow, I'll just start with a bit of an intro, talking about the bigger picture where markets are at the moment. We think it's quite easy really to explain from a macro point of view what's happening. You're probably finding, as we are, that explaining why each asset class or each market is moving in the way it has done just recently and why it is where it is more difficult. But the reason for that is because markets are in a state of flux. Things are changing quite rapidly, and therefore where valuations are at the moment, in many cases, that's not where we'd expect them to remain once this current period of uncertainty has worn through. So the real cause of that uncertainty is markets are really moving from a period that was highly unusual into what's likely to be a much more normal period for markets. So we could describe this process as a great normalization. But the abnormal period was so abnormal for so long that it started to feel quite normal from about the middle of it until probably quite recently. So I think to sort of start the story of where markets are at the moment, we've really got to begin at the beginning of the last cycle, which we think was the global financial crisis. And if you recall, that really started to develop initially in 2007-8, and the UK had proudly had the first bank that failed, which was Northern Rock. And at the time, Northern Rock was seen as a one-off bank that had lent too much money to too many people who couldn't really pay it back, and it was considered an isolated event. What we saw, though, really is through the subsequent year or 18 months, that what happened to Northern Rock actually was a problem that spanned most of the major Western banks. And it was the UK that first found what appeared to be the solution to this, which was later described as quantitative easing. So when a bank fails, essentially governments have two options. You either let the bank fail and the depositors pick up the cost because they essentially lose their money, or the government has to bail the bank out in one form or another, which usually involves taxpayers' money. But the route taken on this occasion was, rather to use taxpayers' money, it was to use printed money, effectively money magicked up, to resolve the problems in balance sheets. And as the UK embarked on that process, like with many things that have started in the UK, the jet engine, the telephone, the internet, many more, it starts here, the US does to a much bigger extent. And the US embarked on its troubled asset relief program. It was considered to be enormous at the time. The figure was 700 billion. I think it was Frank Paulson went to Congress for and was granted. And there became a new era of low interest rates and printing money. And what was described as something that was only going to occur in an emergency situation actually built for the next decade. So emergencies are normally considered to be fairly temporary, but on this occasion it lasted more than 10 years, and the numbers became quite staggering. So as with policies that don't appear to have a victim, if every time you have a problem you can print money to get out of it, it's sort of everybody agrees with it. The only people who didn't really like quantitative easing was the odd academic that will point out ultimately there's an inflationary consequence to this policy. But other than that group of people whose arguments were usually fairly convoluted and therefore easily dismissed, everybody else embraced quantitative easing as the answer to each successive problem, which went from the banking crisis to the European debt crisis to pretty low levels of growth. And then ultimately the big one, which was the pandemic, which hit, as we know, 2019-20. And what we started to think even a few hundred billion was a shocking amount of money to print. But in the end, the overall figures of money printed across the US, UK, and Europe, it came to about 15 trillion. And this policy was only really going to be abandoned when there was a negative consequence. And that came for the UK, maybe ironically, or maybe it's just things where things start is also where things finish. But when we announced the mini budget just a month or so ago under a new government, and yet again the policy was, well, we've got a lackluster economy, let's reduce taxation for growth, let's spend more, let's not really explain how we address that gap, assumption being further printed money. Markets said, actually, that's enough. And with the prospects for inflation and really a lack of identification where this funding gap was going to be filled, who's going to be buying this debt that would have to be created, we saw a very sudden increase in the cost of borrowing. And so that period, we think now, of that quantitative easing decade or more, rapidly ended when the UK overstepped really market boundaries. Now, just as we've seen that being a problem for the UK, it exists exactly the same in all of the other markets that I've mentioned, Europe, US. And so really the ability now for economies to move forward with that sort of loose money, that loose fiscal policy has really been limited. And the shock of that is that borrowing costs have rapidly returned to what we'd call normal levels. And that has an impact on all assets in all markets. And that's really what we're dealing with at the moment with the state of flux we're seeing in different asset prices. So that's sort of my introduction, a broad picture. If I just put the slides on the screen and start to look at some of the detail. The notes is just to cover, because I know some clients might see this presentation. So nothing's intended as advice. Happy to give our views throughout the course of this, but we don't intend those views to be any sort of recommendation, and people should always take advice before making any financial decisions. I'll cover all the headlines as we go through the presentation. I'll just leave this slide up there for a few seconds so people can read through all of the different things that are happening at the moment. And this is by no means the full list, but it gives. We try and keep the bullet points on our headline slide to a smaller number as possible. And so you can see, this is quite a busy slide. And I think that demonstrates just how many different things are occurring at the moment within markets and the global economy. So if you just come back to a few things from a market point of view, this is an up-to-date slide, and it just shows the key markets using peer group averages for North America, Europe, UK, Asia, and I put sterling corporate bonds on as well. And what you can see over the last 12 months is the US market has again significantly outperformed all of the other major asset classes. And all of the others are sort of grouped somewhere around the minus 14 to 18 mark. And the US is, we won't call it break even, it's a touch under break even, but a much smaller level of loss. And so, up till this point, portfolios over the last year with more US exposure would have just done better, because there's not really many major asset classes that have been able to keep up with the US. And we know why that might have happened over a 12-month period, particularly recently, because one of the effects of the Liz Truss mini budget was a real reduction in the value of sterling. So most of that benefiting dollar investments, with that currency decrease in sterling, increasing the value in sterling terms of overseas assets. But it's a picture that's been going for a long time. So I just put 10 years on. I mean, really, to get the longest period of outperformance from the US market, you go back to the same period as the global financial crisis, 2008, gives you the sort of the entire picture of US dominance. But even over 10 years, if you look at some of these numbers, US market is up 285%. UK beleaguered a little bit with a lot of loss of confidence around the Brexit years, but underperformed the US market by what is given only a third of the returns, i.e. US stocks have generally given 3 times the performance of UK stocks. But again, you see UK, Asia and Europe, they group fairly similarly. The US market sort of way ahead. And I left the Sterling Corporate Bond Fund on there just as a reference point. So the last year, the last 10 years, all really been about US markets. And from an asset allocation point of view, the more US really, I think the better performance has been. So to try and sort of explain, in a way that makes sense, what's happening at the moment, I've covered up the bigger picture, which is that the cost of borrowing is going up. But what's triggered that is really that the inflation started to rise. I mentioned that we're now moving into a period of normal market conditions from abnormal market conditions. And really the trigger for that has been a significant increase in inflationary pressures. We all know, or it's accepted wisdom, anybody who's attended any sort of history lessons, that if you print money, ultimately it becomes inflationary. And the biggest surprise to us at the moment is not that we've got inflationary pressures, it's more how long they took to develop, given the extent and use of quantitative easing of printed money. But in the early days, the printing of money was done very carefully. It was injected gradually into the bond market, so it didn't really end up in people's pockets. But by the end of that cycle, through the pandemic, there was just direct printing of money to give to people. So we called it furlough in the UK. It was grants in the US, or grants in the UK as well, of course, all sorts of lending schemes in all the developed economies. But it was it was no longer a safe way of printing money. Money was put directly in people's hands and then spent in the high street. And that's created a shockwave of inflation that we're only partially through. We think this sort of skipping rope of shockwaves is going to continue. So let me just go back. Now, of course, initially when you lock down a global economy, you create disinflation, or inflationary effects are reversed because you essentially shut down demand and supply. And one of the key drivers of inflation are energy costs, and unsurprisingly, oil price, gas prices plummeted, almost became negative, and so inflation was very, very low. And the pressure in Western economies, particularly, was to unlock as soon as possible, demonstrate that you had an effective COVID vaccine, distribute it, and then essentially allow people to go about their normal daily lives. And that was a very popular thing to do. But of course, it was inflationary because all of this money that was now built up in people's bank accounts, you didn't release it slowly and allow supply chains to catch up. It was an earthquake of spending that came with the economic reopening. And unsurprisingly, we think we started to see inflationary pressures grow. And central banks saw inflationary pressures grow as well, but they described it much more as transitory inflation rather than permanent. We thought, and wrote at the time, that we thought that was a bit of wishful thinking, but nevertheless, we could see some of the arguments. But to put that beyond any doubt, I think to our surprise and the surprise of global markets, Russia then invaded the Ukraine. And the reason that was a surprise is because it was clearly a very bad idea for everybody, but particularly Russia. And in doing so, it created shortages of basic foods, but particularly energy, oil and gas, either because the war affected the production of those commodities or through the effects of sanctions, which were rapidly applied by Western markets. And this then took what was a hot period of inflation and exaggerated it still further. To the point now, please accept that the figures are illustrative on the left-hand side, and there's lots of measures of inflation. But I think it's generally accepted that we have been or are currently into double-digit inflation in most of the major economies. Now, we think those initial inflationary pressures will ease a bit, and I've got some evidence of that. So that's our current estimate. But bear in mind, it's a current estimate on a slide that we've effectively designed just to show figuratively how things are likely to develop from here. The thing about inflation is it's a delta, which means it's a measure of rate of change. So people usually find it really difficult to understand the delta. We're quite used to a speedo in a car that goes from 20 to 30 miles an hour to 40 miles an hour and back down again. But a delta measures how quickly you go from 30 to 40. So if you go from 30 to 40 quickly, your delta goes up. But if you then stay at 40, your delta comes down to zero because it's not changing. And so with prices having risen very significantly, if they stay high but don't get any higher, inflation comes rushing down because there's no longer a rate of change. And I think that might be an important point to remember as we go forward, because we think prices will stay high, but the delta, the change at least, will come down. But from there, will that be the end of it? Just one sort of phase of inflation? We don't think so. There could actually be several phases, but the effect of the current inflation that is obvious is that you get a lot of pressure on wages. We're seeing much more union action at the moment, pressing for higher salaries, and you can understand why people feel that their standard of living should at least be maintained. Therefore, they want an inflationary pay adjustment. And as those salary increases come through, that actually becomes more embedded long-term inflation, which picks up a secondary base effect. And then at some point, the skipping rope levels back down again to a more normal market condition. Now, even though we've put the skipping rope on the screen, it will be very difficult to manage a portfolio for these. Essentially, central banks have become very hawkish because inflation has rushed up. If we're right here, they might then become quite dovish and the market will respond positively, only to become more hawkish again, and so on. The scope here for investor expectations to change rapidly and for policy errors to be made, and then for markets to interpret policy movements incorrectly, is huge. So this flux that I've mentioned, I think is going to continue. But what we think we can say with some certainty is that the 2% long-term inflation expectation that we had all the way through the QE era, because that's what central banks were targeting and struggling to meet, in some cases, not that inflation was running too high, but too low. We think actually long-run inflation is now heading back up to sort of 3-4%, and that has a material effect on the way assets ultimately level out from this current volatility. Just to try and show some evidence really for these points. You know, if I'm saying, or if we have said that we think there'd be a rollover in inflationary effects, that we may already be over that initial hump, you would expect us to be able to provide some evidence to show that's happening. So on this slide, I've looked at European gas measured by the Dutch natural gas futures. That sort of is a broad measure for what gas is costing in Europe. And then oil on the right-hand side, probably more familiar with the oil price. There's something worth mentioning here in terms of the difference we think between a capitalist economy, a free economy, democratic economy, as we have in the West, and a command economy of China and Russia and a few others. And what never really fails to impress us is that when you present capital or democratic economies with a problem, their ability to solve it is really quite incredible, because there's that entrepreneurial spirit, there's that profit motive, and therefore, although hardly anybody's got the answer, the few people who do have the answer, or feel they've got the answer to a particular problem, can usually gather together the tools and the resources to demonstrate that very quickly. And if I just illustrate that with what happened in the pandemic, initially when the economy closed down, there was a real sense of fear amongst most people, but it eroded quite quickly because the masks that didn't exist were found. The PPE equipment that wasn't available became available. The solutions to separate people, they were found. Compliance was generally very, very strong. But then when we get to the really clever stuff, the vaccines, they were found, developed in record time, tested, delivered, and ultimately have led our economies out of that pandemic far faster than many would have predicted in March 2020 with the original lockdown. If we look at the response of Russia and China, completely different. Vaccines much less effective, and in fact, in China, still struggling with a zero COVID policy even now. And we've seen the same with the Russian invasion. So there was a view that we get so much Russia in Europe, so much gas from Russia in Europe, and with a shutdown of Nord Stream 1, or the reduction in supply and the ultimate shutdown of Nord Stream 1, the view was that Europe would freeze this winter. But although the gas price rose significantly, the market found ways. Power stations turned to coal. Some power stations were able to use oil instead of gas. Nuclear power stations were able to extend considerably their lifespan in some cases, their output in others. Liquefied natural gas, which was only really imported in small scale. Europe rapidly increased its ability to deal with liquefied gas. And as a result, German storage of gas reached nearly 100% ahead of the winter, which wasn't expected, was not expected in the summer months. And as a result of that, firstly, the increase in gas prices moved the market, effectively got anybody who could deliver gas to deliver it because they got well paid for it. But now we see quite a big reduction in gas prices. So that big inflation peak that I've just mentioned, there's some early indication that actually the delta, that rate of change, has now gone from going up in the very short term, it is now turned to coming down. Similarly, and I'll try to keep it a bit quicker because it's the same story, but it's exactly what's happened to oil. I think we've got to remember that inflation was not as low as we thought in 2020. When you've got an oil price at $25 a barrel, you're effectively being paid by the oil producers to use oil. It costs them, it really does cost them more than that to get it out of the ground and transport it to the UK in this instance and then refine it. But because there was so much oil in the system and nobody wanted it, that's what the market did. Now, from 2020, oil has been gradually improving in price as Western markets successfully quickly dealt with the pandemic. But we didn't really get the deflationary effect of the drops because there was inflationary elsewhere, but we have got the inflationary effects of the rises. But what we can see subsequently is the price of oil has dropped now from the peaks that we witnessed 3 or 4 months ago and has started to level out about $90 a barrel. And it is worth mentioning that the price of oil is now lower than it was for that whole period from 2011 to 2015-ish, which was all during the quantitative easing years where we didn't have any inflationary pressures. So if we think inflation's coming from the oil price, I mean, of course it is to some extent, but we've got to remember the world has seen oil prices persistently at these levels before, and it hasn't had the same inflationary effect. So there's clearly other factors involved. Just in case you're wondering why the oil price rose so sharply during the global financial crisis, it was because China started a big infrastructure spending program, a 5-year plan, and they were building so rapidly. The energy consumption to do that was very significant. So this is a bit of evidence, and there's quite a lot of it out there actually, that inflation is just starting to nose down. So we've got to put all this into the context of bond yields, and one of the best ways to do that is to look back a very long time. So here's a chart. I've used this quite a few times over the years. You might have seen it. I've narrated it slightly differently now. But this shows the borrowing costs of most or several of the leading developed economies going back to 1900. What you can see is roughly the average cost of capital to governments is 4%. So mean reversion tells you at some point you're very likely, almost certain, to see 4% again. And around the early part of this century, you saw swings in and out of that, even through 2 world wars. And then into the 50s and 60s, you saw a big rise in the cost of borrowing. And that coincides, as borrowing does, with an inflationary, a period of high inflation. And if we marked on this graph when the Cold War started and ended, it actually started just after the Second World War. So as you see, around the point there, mid-1940s, and it ended, forget the year, around mid-80s anyway, with the fall of the Berlin Wall and the USSR is essentially disbanding. And it's no surprise really there was high inflation during that period. The word credit actually comes from a Greek word credo, and it simply means trust. And the more you trust somebody, the cheaper credit is. You lend to people you trust more cheaply than people you don't trust. I think this probably stands to reason. And the Cold War was a period of where there was a real lack of trust globally, a real lack of global trade, deglobalization, and quite high inflation. And not only was there all of these problems and high inflation, central banks didn't really know what to do about it, and therefore it wasn't really tackled. And as we know, the myths of interest rates getting into double digits. At the end of the Cold War, then we saw a period of increasing global trust, of increasing trade, of globalization, of China being admitted to the World Trade Organization and therefore able to trade with the US principally, and ultimately become the manufacturer of the world. And that process brought down inflation, brought down prices, and brought down credit. To the point, though, that when we entered the global financial crisis, you can see that the cost of borrowing fell well below that long-term average. And it got to zero on this graph. And for some countries, and even for some companies, it became negative. So the prospect of inflation, being able to borrow with the lender actually paying you some money. So Germany was in that position. I think Nestle actually got some debt away as a company on a negative yield. And that I think looking at this graph and even remembering at the time, it just seemed wrong that the cost of that money should have so little value that you couldn't attract any interest rate on it. And as we looked at our inflation prospects earlier this year, we expected this to normalise over a period of time, we thought inflationary pressures will build, central banks will ultimately see it's not transitory, it's permanent, yields will creep up, and we were predicting the purple line, a period of adjustment where yields generally rise and markets normalise, but gradually. Now, it turned out that was far too optimistic of us to believe that, because what's happened is a rapid adjustment of yields, almost in market terms overnight. It's taken a few months from these very low levels to bang pretty much 4%. And when you do that to bond markets, and bear in mind, bond markets are the most liquid markets. They should essentially have the least volatility. They should be able to anticipate far better market events. That level of change that quickly creates huge currents in markets that will take some time to fully settle down into a lower level of volatility. Something worth mentioning, which I've just inset here, is that the sort of stocks that benefit when yields fall are the growthier stocks, so what we might call tech companies. And they don't have to be tech companies, but they're simply businesses that don't make much money today, but they're expected to make a lot of money in the future. And therefore, the market doesn't want high levels of inflation because those future earnings get eroded, and it doesn't want high borrowing costs because generally these companies that don't make much money today usually need quite high levels of capital investment, and therefore they're reliant on the debt markets. So I just inset that. So as you've seen this blue line fall, that's been quite good for these growthy type businesses, high multiple businesses. As we've seen yields rapidly go back up again, in some areas, not in all areas, we've seen multiples rapidly come back down again. But I'll touch on that in another slide or two. Just to show you, put into context how quickly this has happened. This graph, which I just took from the FT website, shows how much it cost to borrow for 10 years if you're the British government. And so if we look how low it got during COVID, the low point was the British government could borrow for what, 15 bips per annum for 10 years, not almost for free. Almost investors were giving them money or lending them money for nothing. And really from the start of this year, we saw those costs going up. But now 10 years is costing the British government 4%. And you just got to think of what that does to values of assets. So if you were invested in, let's say, a commercial property, let's say you bought a property and you're renting it out. The Gherkin in London is often cited as an example. It's a trophy asset. I think a big investor bought that on a very low yield. Let's say it was 3% a few years ago. Well, if government debt is only yielding 15 bips and you're getting 300 bips from by owning the Gherkin, it seems quite attractive. But now you're actually getting paid 1% less than just lending money to the British government, and ultimately the British government is considered the perfect borrower. They will always pay you back. Maybe not so for a tenant in the Gherkin. So on that basis, the Gherkin should be yielding something like 7 or 8% today. That makes a big difference to its value. Huge amounts of capital losses, and some we've seen recorded in some markets, and others not so much. So the reason slide keeps clicking on is I think it must have a timer in the background. So, one way we measure valuations is what's the price of a stock and what are its earnings, and what's that a multiple, i.e., how many years do you need to own the stock before its own earnings, its own profits should have paid you back? And the lower the number, the better value that stock is. Now, a stock can have a low value because actually it's got some earnings this year, but there's so much competition in its marketplace. It could be the Kodak of cameras. It's got good earnings, but the growth in smartphones means that no one wants films anymore, for instance. Or it could just be that it's out of favour and it's cheap. So low earnings ratios aren't necessarily a good sign, but often indicative of value. So if we look currently, this slide's only a few days old. These are the current P's on markets, price earnings ratio. So Italy's of the selection on this list at least is the cheapest at 7, the UK 9-ish, Germany 9-ish, Spain 9-ish, Eurozone 9-ish, France 10, all pretty close together. Japan 12, world, well, that's got a lot of US in, which we'll come to. Emerging markets 10, and then the US a huge multiple the rest of the market. So you remember I started off with a slide saying the US has done really well over a year and over 10 years. It has. But the multiple that investors are paying for that market is much higher. Now, there's always been a sense that the US should have a premium because it's the US, it's the biggest economy, it tends to be the biggest company. So again, but at the end of it all, money is money and earnings are earnings. And a lot of the companies in the UK are global businesses, banks, oil companies, even pharmaceuticals. Their earnings are as good and as valuable, really, as a company listed in the US. And therefore, this level of differential to us is hard to explain, but it's been going on for some time. You can see here that we've looked at the highs in 2001, where we are versus the highs. But if you look at the long-term average, you see that the US is still trading above its long-term average, with every market significantly below it. So the US is a bit of an outlier, both in terms of its performance, but also in the valuation stretch. And the next slide really illustrates that. It simply shows in the grey line here is what's the average valuation of the world without the US, i.e. the world disregarding the US, against the US market. And it shows that the rest of the world has had a discount to the US for a long time, really. This goes back, 20 years. Briefly, the US has had the same valuation. So particularly when Lehman's failed, and there was a real sense that the US economy was in trouble, You have parity. The US was only worth the same earnings ratio as the rest of the world. But then under the quantitative easing years, that cycle, and bear in mind the US has a lot of growthy type businesses, especially compared to Europe and the UK. We saw the valuation of US markets really increase. And by about 2016, it was nearly higher than it had ever been. And now it's gone beyond that to currently being at well over the highest it's ever been, and about 2 standard deviations away from the mean, which statistically is a place where graphs don't usually stay for very long. And it looks vulnerable to us. So something I'm sure most people on the call will know is that we've been underweight the States for some time. And the rationale was really when the US became more expensive compared to the rest of the world than it had ever been. That was around the point that we felt the US didn't deserve such a high weighting in portfolios. But clearly, that has not turned out to be a great decision with that valuation extending and extending. But it does look very vulnerable at the moment, we think. So I'm just going to take a slight aside now and talk about risk, because part of our job is really to accurately assess the level of risk. I think generally we've been successful at that, because looking at the performance of our portfolios, the low risk have fallen less than the high risk, and that's really what should happen with risk. But it's not what's happened, and that's not to say we've generally outperformed, because that's not necessarily the case, but we've performed against the level of risk that we set out to take. Whereas we've seen markets turn upside down. So we've used the Vanguard funds here, which simply blend equities and bonds between 100 equity down to only 20% equity. And ordinarily, it's expected that the more equity you have, the more risk you have. But whereas the highest risk strategy has fallen, in this example, 4%, the lowest risk strategy has fallen a much more significant amount. And I think this just shows that markets aren't currently operating in the way that is generally expected. And the ability to understand the value of assets and the future value it is currently very important, because clearly a cautious investor who finds himself having lost more than nearly every other type of investor, will probably be scratching their head trying to understand why risk has changed to that extent. But it really comes down to that change in yields. As I mentioned with the gherkin, when the yield required to be attractive goes from 3 to 7%, if something was 3% of £100,000, for that same income to be 7%, then you're going to see a fall of 35-40% in capital terms. And it's in this sort of market that we see those low risk assets with a fixed return being very vulnerable to the combined effects of inflation, which obviously erodes the value of a fixed return, and also interest rates, which encourages a lower valuation in the first instance to offset that increase in interest. So, where does it really leave us from an investment point of view? We've seen some permanent, from a Margetts perspective. There's lots of things we try and achieve as investment managers, but we want to find good assets that are going to provide the returns we expect over time, and we're willing to be patient. What we want to avoid, though, before we even look at those sort of assets, is anything that's capable of delivering a permanent loss of capital. Because although it's uncomfortable, assets that fall but then recover, after the recovery, you forget the pain of the negative valuation during the ownership journey. But assets that fall in value to the extent they can't recover, well, simply that's a total loss. It's a write-off, and it's very painful to investors. So one of the parts of our investment strategy is to avoid those types of assets. Irritatingly, they can often look very attractive for some time, but if we look at some of the assets that have lost, well, let's just give an example. In the technology crash of 2000, we saw technology stocks that fell, a lot of them that fell 95%. And you can imagine if you invested it at something with a £1 share price and it's fallen to 5 pence, even if it doubles, doubling is quite exciting after that, but you're still 90% down. Even if it quadruples, you're still 80% down. The prospects for recovering your initial investment are very, very low. And we've seen the UK government issued a 50-year bond a couple of years ago, and I think it was yielding 75 basis points, i.e. 0.75% for 50 years. And issued it roughly at £1. Yeah, a short time ago, that was trading at 40 pence in a pound. So there's arguably what might be considered a low risk asset lending to the British government, and there's a 60% loss in the capital value. And even though the yield's gone up to 4%, it's pretty small comfort, because it's still going to take you 15 years of yield to get back to your nominal value. And then with 15 years of inflation added on, in all honesty, it's probably very difficult to see that really recovering from an investment point of view. So we've seen that there. We've also seen things like cryptocurrencies lose a lot of value. We've also seen some trouble in technology stocks. There's high multiple stocks. I know they've been strong performers since quantitative easing policies were introduced, and we're seeing more concerns there. I was particularly surprised to see Microsoft struggling overnight. It announced results that were reasonably good, but it's just the earnings growth came in under market expectations. And if you're a stock that's on a high multiple and you stop growing, investors start to sell out of those positions quite quickly. So we don't feel that we've held any assets that are capable of permanent capital destruction, although we've seen quite a bit out there. Other areas, I've mentioned commercial. The Gherkin is a really an example of commercial property, and we think that that's an area that could struggle with higher borrowing costs. And probably residential property, which doesn't tend to fall, but it stagnates for a long time because sellers just won't sell if they're selling for less than they bought for. So you only really get distressed sales. So we're expecting some of those sorts of problems. But as much as you might be tempted, or just an observer might be tempted to sell out of something like UK, Europe that's performed badly and into the US, you're selling out of an area where there has been some reduction in capital values into an area where there hasn't. But all of the factors that have driven UK, Asia, Europe lower, we think currently apply to the US. So we're partway through that normalization story. And in the first phase of the normalization, the US has attracted assets because of flight to quality. But those multiples, those capital value adjustments, we think remain applicable to the US. So we're not looking to rush to that market at this stage. But after we'd seen a general rebalance in the markets, that could be more interesting. It has been the fashionable assets that have struggled more. I always think crypto was a fashionable asset, but things like Tesla, very fashionable stock, has really struggled of late. Things like Netflix, once the darling of the market, Facebook, and a big part of the growth story a few years ago. You just seen those valuations have rolled over, and in some cases it's been quite aggressive. The areas we really prefer are businesses that are solid, old economy companies that are producing good earnings, paying decent dividends. Now, they might not have big expectations of earnings growth, as you find on the excitable stocks, but they bring with them some certainty and actually some ability to, if they've got pricing power, ability to resist inflation. And with an uncertain inflation outlook, we think that's certainly got a value. The growth stocks, well, it's not the old growth stocks that we're interested in anymore. If you look at UK smaller companies, US smaller companies as well, you've seen a big sell down in those small stocks. And yet, during periods of change, the smaller companies often show an ability to adjust and adapt more quickly. And we think with those low levels of valuation, we're not there yet, but that's the area that we think there might be a real opportunity to move to, because those companies with small earnings today, but adaptability, could provide that sort of that growth that justifies the higher multiples that we're moving away from in the larger companies. We're not used to inflation. It's going to take people a little while to get used to it. I mean, during the 70s and 80s, you didn't want cash. You always wanted to invest. Even in recession, assets generally did quite well once markets had adapted. We're seeing company earnings coming through reasonably strongly. Now that doesn't surprise us, because if your earnings are the same this year as last year as a company, you've actually gone backwards by 10% because inflation's had that effect. But we're used to recessions where company earnings fall. In a recession where this way around, where it's inflation essentially driving interest rates higher. We're not going into a recession here with falling interest rates. We're going into a recession with rising interest rates. Actually, company earnings overall do okay, although within that you get some really painful losers and some quite exciting winners. Exactly the pattern we've seen. So we prefer the real assets, low multiples. We really do like the UK at the moment. I'll just touch on the UK. Completely unloved. Lots of damage globally to our reputation through Brexit, more recently through political uncertainty. So no surprise really that UK markets have been abandoned by a lot of international investors. But we've got to remember the key attractions of the UK. We pretty much wrote the legal system and the way markets operate for the world. The transparency, the skill, the diligence, the integrity of the UK market and the economy still rank very highly globally. We have been backed by a lot of North Sea energy extraction, which have been totally undermined by cheap Russian gas and oil over the years. You're seeing now huge reinvestments in North Sea oil and gas, because Europe essentially wants security of energy supply for reasons entirely obvious, and therefore the higher cost of North Sea extraction is now irrelevant compared to the desire to have Europe being able to supply a lot of its own energy needs. And with that reinvestment in UK energy, and there's plenty of energy under the North Sea, it just was more expensive to get hold of. As we see that extraction develop, I think it points to quite a strong currency, improves our balance of trade, which is one of the key problems with the UK, and actually is one of the best short-ish but definitely medium-term drivers for the UK economy. I did put Asia on this slide. We're clearly seeing some upset in Chinese tech stocks at the weekend. China's moving more and more away from free markets and into communist policies, and that's definitely a concern for investors. We've already seen a big regulation of tech businesses, but in terms of demographics, economic growth, and market and valuations, Asia remains very attractive. I know we've seen a big revaluation of fixed interest, but one thing we've got to remember is that the yields have only moved up to about a high threes, and the pendulum effect of markets means you rarely get a market move back to the fair value and then stopping there. So we are thinking of move, and we have begun actually even this quarter to move a little bit out of short dated bonds into slightly more towards a medium dated. We think the opportunity in fixed interest of the longer dated isn't really there yet, and there's still further capital loss. If you saw yields swing up even temporarily 4.5%, 5%, that might give some sort of an entry point. But just to try and give a summary of everything I've said before I answer questions, is that it's not been an easy period for investors. During quantitative easing, markets have pushed stocks, some things higher than they really ever deserved, creating anomalies in pricing. And we're moving through a painful process into a normalization. But the markets we move into will be far more friendly to investors than the ones we've seen for the last few years. And we'll start to see the normal rules of investment, where good due diligence and diversification and balance in portfolios is rewarded. Whereas what we've seen really for the last few years is one market dominate to the exclusion of others. And this period is likely to be a reversal of that. The pain for investors is this normalisation will take in from obviously the end of this year, probably most of next year before we sort of come out of it. And investors might say, well, why not just go to cash or take a 4% return that you can get from the bank at the moment? And the answer to that is because actually forward-looking returns from here look a lot better than that for markets, despite the headwinds that we face. And the final note is we don't know. The Ukraine-Russia invasion is not working for anybody, and common sense says that there should be some sort of resolution. Either it becomes a much smaller war that has less effect, or there's some sort of negotiation. Now, there's clearly no sign of that. But remember, there was never going to be a Brexit deal until there was one. You go from sort of a totally bleak outlook to an optimistic one very quickly in political terms. But that would certainly give quite a lift on markets were it to occur. So what has been a negative is probably more of an upside risk from here. So that completes the slideshow. Can I hand back, Alex? I know there's a few questions.
That's great. Thanks very much, Toby. And those last points there, I think, are an illustration for clients, especially, I suppose, of the difference between investing and guessing. You don't know when there'll be a resolution to Ukraine, for example. So you stay invested and you avoid that risk of going in and out at bad times. We've had various questions from the advisors, and I've got them collated here, so I can just go through them. You may well have answered some of them already.
Okay.
I'll start with the corporate bond questions because we did touch on that at the end. So Deborah asked a question about some of the corporate bond funds in the lower risk portfolios have sort of double-digit falls at the moment, and is there an expectation that they will recover, and how long that might take, given interest rates are likely to stay higher for some time? And combined with that really is Adam Claydon's question, which says that Margetts have had a lower exposure to bonds for some time, and that's obviously paid off recently. Does that mean that we should expect to see an increased allocation to bonds? Again, I think you touched on that at the end. Yeah. I suppose it's the view on bonds really in that respect.
Well, we've been a bit surprised. This is an area where our views have been correct. We've had short dated bonds, and then we've seen a collapse or a big increase in yield, a collapse in value, and those bonds have significantly outperformed traditional corporates or government bonds, but they still lost a bit of money, more than we thought. The short dated bonds are down about let's say 10%, but what we've seen is a big increase in the yields. And part of what's happened in this recent market turbulence is when people need to raise money, they go for the parts of the market that are liquid, and for a while, the only thing you've been able to sell if you need to raise a lot of money is short-dated bonds. So the short-dateds are yielding, 6-7% or were temporarily. So that although you've lost that 10% in capital on evaluation, the yield's going to sort of top that up quite quickly. The BlackRock fund that Deborah mentioned is more like 17-18% down. The average bond maturity is still only 7 years for that portfolio, but it shows how brutal these capital reductions can be. But again, the yields on that portfolio look to be more in the mid 7%, which we think is very attractive from here. So we've been moving in our daily managed portfolios, which will come across in the next quarterly update, which is very soon, a bit out of the short dated bonds where we've had less capital falls into that BlackRock bond. But it's not a big shift. It's a move. It's a semi move into a slightly better yielding bond portfolio. But if you mentioned about permanent destruction of capital and temporary. If you've lost 16-17% and you've got a 7% yield for the next few years, you're going to get that capital back in 2.5 years. But in reality, I think some of that increase in yield will come back again because it's been induced by a market volatility event. So I suspect you'll get quite a quick recovery from all of the bond portfolios that we've got, because we haven't had the ones that we haven't had any of the long dated funds that have really seen a massive fall in capital.
Great, thank you. The other questions, a lot of them are obviously about the recent political upheavals and shenanigans in the UK.
Yeah.
So we've got a question from Lisa about how the markets might feel if Labour was to come into power at some point, if something else happened to the Tories. And Jonathan, a similar sort of question, which is, I can't see any direction with any party in the UK at the moment. How do we and the markets plan or guard against that?
Well, we've got a new Conservative government in place, and I think there's some hope now that there are some adults in charge, because the Boris Johnson era was really a necessity to get over Brexit. His big policy decisions didn't seem too bad to us in terms of the pandemic, particularly. The appointment of Liz Truss, I mean, that would just go down as an embarrassment, I think, for the UK, because the MPs did vote for Rishi Sunak to be their leader, but the party reversed that and gave them the option that had the least support. And then given the budget she tried to push through, or the mini budget, yeah, it unravelled quite quickly. I don't think the market would differentiate now between a Conservative or a Labour government, and I think generally political leadership is weak and has been so for some time. So we would hope, not that hope's strategy, to see just better political leadership in the UK, and it might come under this Conservative government, making it possible. But what is clear is the markets are now ruling our economic strategy. So it's what choice does Conservative? Liz Truss thought she could implement her policies, but the market rejected them with so vehemently. It's not even a choice now. We're going to have an austerity budget, and that goes for Europe and the US as well, because the market just isn't willing to fund debt at the long end at 9%. So I think we're probably through the worst of the political crisis, I hope. But then there doesn't seem to be any good news coming anytime soon. Conservatives aren't going to allow, they're not going to vote down their own government for a general election with Labour so far ahead in the polls. So I think this is it for the next 3 years. Can they do enough to claw back some credibility?
Great. And Bob's question, which I suppose leads on from that, keen to understand about what your views on interest rates are, and if the political situation is more settled, will they start to come down, or is the need to control inflation going to mean that they carry on going upwards? Do you have a view on that?
I'm glad you asked that question, because I meant to say during the presentation that central banks have got a 2% inflation target, but that's never been challenged so far. Through the quantitative easing era, I think globalization just kept inflation under control. When banks are faced with a choice of pushing interest rates up higher in an economy that's already slowing, where mortgages are becoming unaffordable, well, they've got to push it up higher the choice is, do they push rates up to beat inflation, or do they acknowledge the harm that starts to cause? And the reality is, I think they will all elevate their inflation targets, and they will all say that it's global factors that prevent them from getting to 2% inflation, and primarily the Russian invasion of Ukraine. And therefore they sort of accept, because you remember in my slide, I said I thought inflation would average out more like 3.5%. And that's because central banks will have to accept that. I think once the next rate of interest rate cuts will put the US roughly, I'm trying to remember where they are, at 4%, and the UK will come out something at low threes. I think there will definitely be a pause to see what the economic effect is from there. I suspect the next pressure will be on further rate increases, because inflation will remain stubborn into Q1 next year. But I think central banks will resist it, and therefore I see a 4% interest rate as about the top of the current cycle for both UK and the US.
So they might pause for breath, but the pressure is still upwards rather than downwards. I think that's the outlook from that.
It is. Now, towards the end of next year, you could see this whipping down of inflation, as I mentioned, and then banks might reduce rates. If they do, unfortunately, I think it'll be seen as a policy error, and they'll have to increase them again. But bear in mind that borrowing rates are really determined by the bond market rather than the spot rate. I think we're going to see the cost of borrowing probably top out towards the end of this year and then be maintained at that level, but with a lot of rankling amongst all sorts of people about whether they should be chasing inflation or economic growth, or what the compromise is, and it's just going to get very noisy, really.
Right, just a couple more questions on different subjects. So Robin Wardrop asked about whether there are any particular geographical locations or sectors that you're positive on. I know we've already mentioned the UK and Asia. Adam actually also asked about whether infrastructure might be, targeted in the portfolio as well. So I suppose sectors, perhaps in terms of sectors more than geographical locations, which maybe you've already covered.
Yeah, infrastructure is actually will probably. We think valuations there are detrimentally affected by the increases in yield. So infrastructure, I think we'll be interested in that, but we'll wait to see where prices level out. We have seen a bit of a drop off in most infrastructure funds the last few weeks, coincided with that increase in yields. Although it sounds like we don't like the US, it's not the US we don't like. It's specifically the S&P 500 and actually the very narrow range of companies at the head of that. US small caps look quite exciting for us actually at the moment. So US smallers, which we've got exposure to, Asia, which we've got to reconsider just based on the weekend, but I still think the arguments are sound, and particularly the UK, where I think you could have a strengthening currency with a mid cap and small cap markets performing quite well. The UK could turn out to be the best market for next year. If I was going to bet for 2023, I would go for UK mid caps actually.
Well, I should probably tag on Adam Baker's question then, which mentioned the bias towards UK equity in the portfolios. He says, what sort of circumstance might happen which would lead you away from being positive about the UK?
Well, I mean, I've mentioned that, and I think I've been really open that the US has been the best market and we've not really held it. And it's gone from quite expensive to very expensive to exceedingly expensive. And we really need to see that occur in the UK. We need to see the UK start to have parity of value. It's been cheap, but it's remained cheap for a long time. We'd really want to see that value released, which even in investment terms, it's been quite a long time. But that patience is a big part, really, of getting the best return. And we've certainly felt that's been tested from a UK point of view. I suppose Brexit was probably the thing that put a real delay to the performance of the UK market, as it turned out.
So buy low, sell high, basically. That's right, the right way around, isn't it?
It's the right way around. I mean, you always know where you wish you had been, but when you look forward, which is what we always do, really from a strategy point of view, you just think the UK looks attractive. And actually, it's not been so bad the last year or so, particularly on the large caps, larger companies, but the mid and small has still been a bit disappointing.
Right, just one more question, which is more of a kind of overarching sort of existential thing, really. Josh has asked the question that, is there a danger, I suppose, with over diversification? If the portfolios are spread so far across the equity and bond space, do they end up acting more like passive portfolios? I suppose that's an eternal problem for an investment management company, is that you're acting on behalf of long-term investors, and it's not a hedge fund. But it's an interesting question, I suppose.
Yeah, it's a fair question, and I'd say that they're definitely active portfolios, but they're market based. They're multi-asset portfolios and then market led. So if markets are up, they'll be up, and if markets are down, they'll be down. So they're trackers to that extent. But in terms of matching portfolios that are appropriate to clients, they should be market driven. Now, there's enough differences in them that we're trying and often are very successful in exploiting where differential performances in markets, equities and bonds, and different parts of equity markets and different parts of bond markets. And there's plenty of activity there. I showed the Vanguard funds and the most cautious portfolio being down 20%, and our most cautious is down about 10 over the same period. So that's a differential of performance to say there's quite a lot of active decision making. But I'd fully accept and wouldn't even expect any different for these portfolios to perform in line with markets, certainly directionally.
Great. Well,
sorry, Alex, I just thought of something. when markets fall, everybody wishes they're in portfolios that hadn't lost value and made value. But the sort of assets that do that are very niche assets that wouldn't be appropriate nearly all of the rest of the time, and that's why we wouldn't really be in that category.
Great. Well, I think that covers all the questions we've got on the list. So just like to say thanks as always for the update.
Yeah,
and
pleasure.
I think you can stop the recording now, Lisa.